thanks very much for inviting me to contribute to the Ant Group session on green finance. And I'm here speaking as the head of the Secretariat of the UN Secretary General's Task Force on Digital Financing of the SDGs. And as a special thanks, I would point to Eric Ying, the executive chairperson of the Ant Group, as having sat on the task force for its 18 months life and contributed significantly to its work over that period. The task force has highlighted as part of its final report 5 catalytic opportunities for trillion or multi-trillion dollar action in harnessing digitalization, in aligning finance more effectively with the SDGs. And I want to, in the next few minutes, just talk about one of those with one particular example. Sustainable infrastructure is the single largest financing requirement in our transition to sustainable development. Estimates range between 3 and 5 trillion US dollars a year for the foreseeable future, much of that being in developing or emerging economies. Historically and today, the bulk of financing of sustainable infrastructure in developing economies has come by tapping international capital markets. But that has just got a lot more difficult. Since 2008, emerging market debt has ballooned to a global total of 71 trillion US dollars, with frontier economy debt now running at about 114% of GDP. So at exactly the moment that an increased pace of investment in infrastructure investment is needed, so the traditional approach of tapping international capital markets has become increasingly difficult. And of course, the pandemic will make that approach even harder. And that brings me then to the matter of domestic savings. So over the same period of time, more or less over the last 15 years, domestic savings globally has increased by 3 times to a total of $21 trillion annually. And for emerging markets, and particularly LDCs, has gone up by a factor of 5. So a rapid increase in the volume of domestic savings now available in many, not all, but many developing countries, much of which is trapped rather than allocated through into long-term development finance. And so the catalytic opportunity that has been identified is very much in this space. How do we use digital in order to draw more of that domestic savings into sustainable infrastructure investment? Through the task force, an initiative has been launched in Bangladesh under the guardianship of the Prime Minister's office, being implemented by a number of digital entrepreneurs and parts of government on the ground, looking at how to move micro savings, so those 20-cent pieces of taxi drivers in Dhaka, through into larger pools of investable funds, and then more transparently driven into investment in long-term infrastructure. The data in Bangladesh is very clear. Infrastructure spending needs to increase by tenfold by 2030 in order to meet its sustainable development goals. Historically, about 48% of infrastructure investment was financed through international means, and going forward, that number will fall in the context of a rapidly increasing need. Looking at domestic savings at the same time, savings now totals $118 billion in the last year, of which only 6% currently channels through to long-term domestic savings. The initiative therefore uses mobile payment platforms in order to draw costlessly, at least at the margin, small-scale micro savings into large aggregated pools. So that's something, for example, that Emma Kiba in Kenya has demonstrated as being entirely workable. To construct, in a country that has relatively weak capital markets, new digitally supported financial instruments that both deliver security of savings and liquidity, the ability of small savers to draw out those savings very easily, as well as a stable investable pool facing, if you like, in the other direction, so that that money can flow into infrastructure investment and other forms of long-term development finance. And finally, using blockchain and other means in order to increase the transparency of the actual flow of funds into the infrastructure. In fact, being able to track bag of cement by bag of cement exactly what has and what has not happened. So a dramatic increase in the level of transparency and accountability. What does this all add up to? So 5 significant advantages that I will just rapidly go through as I bring this to a close. Cost of capital compared to tapping international capital markets over the next 10 years falls by 15 to 20%. Along with that is a reduced pressure on Bangladesh's currency vis-a-vis international forex markets, and an easing of pressure on its credit rating, thereby potentially reducing the cost of capital across its external debt portfolio. Thirdly, the dividends, instead of being paid to actors outside of Bangladesh, the dividends on that borrowing are going not only to Bangladeshis, but are going to poorer Bangladeshis, therefore offering a plus on the distributional side. Citizens, moreover, have moved from becoming savers to becoming investors, and are being given a choice. Would you like to invest in that school that your that your children goes to? Would you like to invest in that hospital that perhaps your parents go to when they're not well? Would you like to invest in that bridge that if you're driving a taxi you need to go over many, many times each day, and at the moment is slowing you down? So citizen choice becomes part of the matrix of long-term development finance. And finally, perhaps behind the scenes, this entire exercise doesn't undermine domestic capital markets, quite the reverse. What it does is it brings innovation into the capital raising space and begins to encourage others, including existing incumbents, banks and others, to move forward more quickly in developing instruments that allow the aggregation of domestic savings as well as international financial flows into long-term development finance. So an extraordinary catalytic opportunity, a fantastic example in Bangladesh, and undoubtedly something that can be done in many different parts of the world. Thank you very much indeed.